सर किस स्टॉक में पैसे डालना है अभी? I'm sure this question comes to you a lot of times.
All the time.
So what is that stock you're telling currently?
We'll never have the patience to hold on to this stock. 4 साल कुछ नहीं हुआ यार, बकवास कंपनी है, छोड़ दो. But that's where they end up generating cash flows. Wealth creation doesn't happen.
You have stocks which have given 46x, 28x, 30x. How do you end up picking these stocks?
If you look at anybody who's created disproportionate wealth, right from Rakesh Jhunjhunwala to anybody else, 60-70% of the portfolio would be one single stock. And that one single stock is the perception about small cap is to make quick returns out of it. And that's why most retail investors end up burning their fingers or hands primarily because you are chasing stock price rather than understanding the underlying business.
2025, it has been really, really bad for the small cap sector as a whole. 2026, what is the outlook for small cap sector?
Well, it's just that
2025, it has been really, really bad for the small cap sector as a whole. Most of the small cap mutual funds, if I look, has given negative returns. 2026, what is the outlook for small cap sector?
we have seen a decent correction. So about 80% of the small caps are down by about 30% in the last 14 months.
80% of small cap companies are down 30%?
30% and more.
Wow.
Right? So that's the kind of deep correction which has happened.
Okay.
On the other side, there has been growth coming back into these companies. So as a segment, small cap is delivered about 13% growth in the first half.
Okay.
On a year-on-year basis. Basis the business visibility and the GDP growth numbers and everything else, we expect this growth trend to continue. Now, last year, Q3 numbers were impacted and Q4 numbers also were a little on the lower side. So if I budget this kind of a growth for the second half, your valuations then in this, particularly the small cap category, comes down to about close to its 10-year average. The premium then goes down to about just 12%.
Okay.
If you factor in the growth.
Okay.
A 12% premium on a 10-year median P multiple is not so alarming.
This is for now, 2026.
This is as we stand now.
As we stand now.
Yeah. That's not alarming. So there's been a decent correction which has happened. Of course, there are pockets in the market which still continue to be extremely expensive, way above their 10-year averages. But there is good number of stocks which have now seen that correction and where growth has come about, where the valuations now are sinking with their 10-year averages.
Got it. So, if I look at your benchmark, the benchmark that you look at is the S&P 500, S&P BSE 500 TRI. That's what you look at. In the 5-year period, that has given, the S&P BSE 500 has given 16.82% CAGR. That's these are the 500, top 500 stocks, right? All of that.
That's right.
Your fund has given 34.53%, which is an alpha of 17.71% higher returns. How does that make you feel?
Wealthy at the end of it, simply put. But yeah, I mean, so that's...
And all your money is in this.
And all our money is into this.
Yeah, you were saying something. I was just looking at the numbers. Tell me.
And by the way, those are post fees and expenses numbers.
What is your fees on this?
So again, the fee structure is more like a private equity fund where we charge small performance fees as and when the portfolio doubles up.
As and when the portfolio doubles up?
Yeah.
Meaning, what does that mean?
So let's say if an investor starts with 100 rupees with us.
No, let's say I give you 1 crore.
So 1 crore, as and when that 1 crore will become 2 crores.
Okay.
If it happens in 2 years, that's the time we charge the performance fees.
Oh, only when my 1 crore becomes 2 crore, which means because minimum is 1 crore.
Correct.
If that 1 crore becomes 2 crore, only then you charge performance fees.
Correct.
Very interesting. So you make a lot of money only when my money doubles.
In fact, we make money only when we deliver the returns to the investors. Because even this expense ratio that you are talking about, unless I recover that, there is no profits where I can compute my performance fees.
Correct.
So I have to first recover that expense. So from an investor's perspective,
So even after doing all of these fees, you are at
35%.
35% CAGR. Interesting. So when I look at picking a stock, if everybody is already talking about that stock, it means that the upside potential is also kind of shrinking.
that's right.
Because at the end of the day, this is an open market and the prices are decided by demand and supply.
Correct.
So if a lot of people are already asking for it, the price has already gone up.
Yeah.
Now, when I look at picking stocks, if that stock is really that good, right? If that company promoter is fantastic and it has a very good future ahead of it, you're not the only one who is identifying it, right? There are 1.5 billion people in India. A lot of people have access to this information that you're looking at.
Yeah.
Of course, not everybody can meet the promoter, but the fundamental data, the annual reports, everybody has access to it for free.
Yeah.
So how are you one of the first ones to get there before a FII or a very large investor identifies it and already takes up the stock price up?
Well, so it's not necessary that we are always the first ones to identify these companies. I mean, from a institutional investor's perspective, they are again spoiled by the brokers. I mean, if you look at...
Can you explain that? Institutional investors like a mutual fund.
Like a mutual fund, right?
They're spoiled by brokers. What does that mean?
Because they end up investing only in stocks which are under the research coverage by the brokers.
Can you give an example? Who are these brokers?
Well, there could be many of the brokers. I mean, there are a lot of brokers who do institutional broking.
No, like when people think of brokers, they're thinking Zerodha, Grow, Upstocks.
No, okay, Zerodha, Grow, these are probably, platforms which have got created where retail participation is extremely high, right? They may not be doing a lot of institutional business. I mean, right from your FII or multinational brokers.
Can you name them?
There are many. I mean, right from your Morgan Stanleys to Goldman Sachs to Indian ones like, there are quite a few of them, right?
Okay.
Who do institutional broking.
What does that mean?
That they cater to these institutions. So they do their research and they provide their research to these institutions.
Like, let's say, a mutual fund company.
Like a mutual fund, right? So if you put all brokers in India put together, the research coverage is not on more than 700 stocks.
Okay.
Which means that when the institution is looking to buy, that pool of 700 research stocks is what they are looking to buy.
How does the institutional broker make money in this? So let's say you are Morgan Stanley and I am HDFC AMC. You come to me saying, Sharan, Zomato is going IPO or Zomato has already gone IPO. I am doing my research, quarterly results here, go for it. Now I will, let's say, invest 100 crores in Zomato. How are you making money in this?
The institutions end up doing the execution with the broker. So the broker is getting his brokerage.
Okay. As HDFC mutual fund, I don't have my own brokerage.
No.
I have to go to your brokerage platform to invest.
Yes.
But I can't build my own brokerage.
Well, most of the AMCs don't. Again, SEBI regulations are there where, the broking business operations have to be kept separate from the AMC business.
Okay, because Zerodha has their own mutual fund company as well as their brokerage.
Completely at a distance.
Acha.
So when Zerodha AMC has to deal, they can also deal with Zerodha or they can deal with multiple other brokers.
Okay.
The more number of brokers that they work with, they get access to that many research.
Okay. So the brokerage company will give me the research only if I use their platform.
Simple.
So it's research first brokerage.
Correct.
But now how do I trust these brokerage companies? Because they will want me to transact more and more. That's how they make money. So every research they give, like essentially what you're saying, as an AMC, as a HDFC mutual fund, SBI mutual fund, Axis mutual fund, I'm just reading these reports which these brokerage companies are sending me. And then I make my decision.
That's the starting point. And then of course they may do their own bit of a research on top of that.
Okay.
But that becomes the basic source of their decision making.
So, but that's the raw material. That's
the
where it
raw
starts.
material, right?
Oh. So, totally how many stocks do you own in your PMS?
About 12 to 15 stocks.
At any given point of time, only 12 to 15 stocks.
That's right.
Very concentrated.
From our perspective, it's like getting into a partnership with somebody where you're trying to take a piece of the
It's like you
ownership.
owning these 10 to 12 businesses yourself.
Correct.
How much do you own percentage stake of that company whenever you invest?
Well, different companies will have different stakes, ranging anywhere from 0.5% to going up to 4% into these companies.
So you own anywhere from 0.5% to 4% of that business.
Correct.
Interesting. So you're sort of like an investor for these 10 different companies, which you think of it as your own company.
Exactly.
Interesting. And you really think of this as your own company.
That's where
But all your net worth is here.
Because all my net worth is here, right?
Yeah.
So now that's where
like if something bad is happening in their business, you actually feel like it's like your own business is going through a tough time.
Yeah. I mean, so that's why I said that this is more like a business investing approach.
And on an average, how long do you stay invested in every company?
About 6-7 years.
Wow. It's a long period.
It could be longer than that. So long as the business keeps growing and the valuations remain within our comfort zone. In fact, of the 15 businesses that we are holding today, about 7 are businesses that we have been holding for the last 7 years.
Wow.
And we still continue to buy. Now that's not normal for a listed market player. Again, because you're spoiled for choices. Every day you have something. There will be times when your company is not performing, somebody else is performing on the market. And you will always be tempted at, okay, why don't I sell this, move over there. But if you come to think of it as a business owner, do you keep changing your business every year? Because your next door business is doing better? You don't think about it that way. Because you have a easy entry exit over here. That's what makes you do these kind of things.
Right.
But the real wealth creation actually happens in owning the business for very long periods of time.
Interesting.
Again, you'll be surprised that of the top 50 wealthiest people in the world, whether you look in India or whether you look global, except one, which is Warren Buffett, each one of them are entrepreneurs. It's the business houses who are largest wealth creators, or entrepreneurs for that matter.
And that takes decades. I'm sure this question comes to you a lot of times. Whenever you're at a party or a function, they would be like, sir, किस stock में पैसे डालना है अभी? I'm sure you get this question.
All the time.
Every week, every day you're listening to this question.
All the time.
Right. Once they hear what you do. Yeah. So what is that stock you're telling currently?
I tell people all the time that, listen, what I may tell you or what I may recommend, you may see swings on either ways. And you will never have the patience to hold on to the stock.
You'll just say them this.
We spoke about HBL, right? 4 years it did nothing. Now, most investors' patience would wear off.
Right.
4 साल कुछ नहीं हुआ यार, बकवास कंपनी है, छोड़ दो.
Right. I think naturally human beings are traders.
But that's where they end up generating cash flows. Wealth creation doesn't happen.
We are not equity investors naturally. We don't understand what is equity.
But which is why wealth creation doesn't happen. If you look at anybody who's created disproportionate wealth, even in India, whether right from Rakesh Jhunjhunwala to anybody else, 60-70% of the portfolio would be one single stock.
Wow.
And that one single stock has changed their life.
All right. So I was looking at your track record. You've been investing for the last 27 years.
Yeah.
Right? So 27 years of investing, and I'm seeing some of your best multibaggers. Multibagger is usually considered when you make 5x, 10x. You have stocks which have given 46x, 28x, 30x, 25x. So clearly you're doing something which very few people in India can do, where you're getting these kind of returns. So I'm curious to know, what is your investment strategy? Like, how do you sort of end up picking these stocks which are giving these kind of multiple kind of returns?
So this is, we just extended the private equity approach to the listed market segment. And what that means is, as a pre-investor, you are generally the early ones to invest into these companies. And when you're buying early, generally the valuations are far more reasonable. Of course, you take execution risk, that will this company scale up to a level as what you expect it to. And at that, then it's also about being able to hold on to the business for extremely long term. I'm sure listed markets, everybody is spoiled for choices. You have at least 10 new ideas coming in every day. The ability to hold on to a business for good 6-7 years, where the business is compounding, is where you end up creating these kind of multi-baggers.
So before you set up these meetings with these businesses, you will obviously look at some, filtration parameters before you even set up a meeting with them.
Yeah.
So what are those filtration parameters?
There are quite a few of them. So to begin with, we look at least the business to be in operation for at least 2 decades.
Oh wow, 20 years of operation.
Yes.
Otherwise they are excluded.
Generally, yes.
Oh my God.
And that's an extremely important aspect to understand.
So but 1100 is the universe.
Yeah.
If you put this filter, how much will it reduce?
Well, it'll come down quite sharply. Quite sharply. Somebody who's been in the business for 2 decades, one has been through enough ups and downs. In fact, statistically, if you look at global companies, 80% of companies shut down in the first 20 years.
Wow.
Next comes the promoter, because that's extremely important. You are backing a promoter, so you need to have some kind of a reference check, or look at, again, that 2 decades of track record helps in terms of looking how the promoter has conducted himself over a period of time. And these companies go through, they evolve over a period of time, right? So that legacy helps you to track how the promoter has evolved over a period of time.
So, but that's a vague thing to look at, no? Like, how do I know if a promoter is good or bad?
Well, the best thing to do, and that's where being a CA helps a little bit, is to go through the annual reports. If these companies are listed for good 6, 7, 8 years, you pick up 7, 8 years of annual reports, go through them, and you will be able to understand, how the trajectory has been, how the transparency is with respect to disclosures, how the related party transactions are getting reported, how the cash flows of the business has been over the last 6, 7 years. And when you try and compare this thing on a 7-year basis, when you go through 6, 7 years of annual reports, you'll have a good hold in terms of how the promoter conducts himself.
Okay. So second is the promoter health.
Yeah.
What is next?
Third is large addressable market opportunity.
Okay.
So every business that we look at needs to have a very large addressable market opportunity.
So that there comes your thesis on what is going to be the biggest next things for India.
Correct.
So what is your thesis?
Well, there are quite a few of them. At a broad level, there are 3-4 macro themes that we see.
Okay.
And that's been consistent over very long periods of time, right? So today, when we look at our businesses, one, the manufacturing bit is going through a massive transformation. Over the last 15 years that I've seen, there's a huge change in the promoter's mindset in the way things were being done. I mean, if you recall, 15 years back, the average quality of an Indian product would be very poor. Today, for the kind of global exposure that we have had, you try and sell a substandard product and nobody would want to take it. Even from the entrepreneur's perspective, they've started realizing that if they want to be relevant, you have to start giving a good top quality product. And when you're doing that and you're cost competitive, you can tap the global market opportunities. So there's a huge export opportunity which is opening up. Now it's interesting to know that India had just barely 2.5% of the global merchandise trade.
Okay.
We've never had any significant presence in the global merchandise trade. So while we talk of the China plus one, and probably will take another decade to get anywhere close to what China is doing. But because of the Europe plus one, there's a huge opportunity which is opening for Indian entrepreneurs.
What is that Europe plus one?
Well, Europe has been plagued with their own aging demographic issues. And the average age is now getting close to about 55 or 60, thereabouts. And at that, post the Ukraine war, when the gas prices shot up, commercial manufacturing is impacted very badly in entire Europe. And a lot of these legacy businesses which have been in existence for good 50, 60, 100 years, they are up for sale. And Indian entrepreneurs are rising up to the occasion where they are latching on to buying these companies which would have global certifications.
Wow. Okay.
You'd be surprised that, I grew up looking at German engineering, and to imagine that a small Indian auto ancillary company would someday be exporting to Germany was a dream that probably nobody would ever think of. But today you actually have small companies. One of our own company in the portfolio is exporting to Germany. There's auto ancillary, auto equipments being exported to Germany.
So can you double tap there for a bit? So this German company is suffering because of the Europe aging population and the Ukraine war.
Yeah.
How is this Indian company able to export it to the German company? What sort of cost advantages does this Indian company have apart from just the the labor cost? Apart from that, what other advantages does Indian companies have from a global manufacturing story?
Well, it's not just the labor. I think one, you have to be right up in terms of your quality standards. And that is something which a lot of these Indian entrepreneurs are rising up to the occasion. That the quality is absolutely top notch. So this one that I'm talking about particularly, they have Mercedes, BMW, Jaguar as their clients. Now it takes a lot in terms of the quality standards to break into this kind of top notch MNC clients. And of course, then you have the labor arbitrage. So in industries like apparel, for example, which is labor intensive, you have a natural edge over there.
Right.
So it's about providing a globally top quality product at a very cost competitive price. I mean, we are seeing this thing happening across multiple things. I mean, you look at defense exports, for example. Defense exports in India has been growing at a compounded growth of 35% over the last 5 years.
Wow.
I mean, India never ever imagined that we could be exporting defense components to some of the developed countries in the world. But here we are doing that thing. Just day before yesterday, you had the railway minister talking about opportunity to the Indian companies where we could end up exporting railway products. And this is top-end electronics and multiple other things that we're talking of exporting to global countries. That's changing the landscape in terms of opportunities. You
Got
see,
it.
I mean, other examples are like what happened in electronics. I mean, all of us know that India used to be a net importer of electronics. Today, we are net exporter. You have an Apple, you have a Samsung, all being manufactured in India and exported to the entire world. So this whole Make in India, PLI schemes and multiple other government initiatives has also helped the industry to rise to the occasion.
Got it. So you mentioned two themes. One is manufacturing, where it opens up the global market for Indian companies because of cost arbitrages that we have. Second is defense, where we're also exporting defense outside of the world. What else are the super trends according to you?
Defense, railways, these are all applications. At the core, what we are looking at is the manufacturing engineering companies.
Right.
You have businesses like valves, for example. I mean, this is a capital goods, small capital goods. But you have companies in India who have gone and set up shops in America. And they are now competing with the global majors in terms of the quality standards. And being cost competitive always helps. So they are grabbing market share from global customers.
Interesting.
You look at chemicals, you look at pharma. I mean, India has proven its might in terms of the pharma R&D as well.
Right.
We were amongst the few nations in the world to come up with our own COVID vaccination.
Right.
We export a lot of generics to the global markets and otherwise. Chemicals, again, we are becoming global majors. So this is across different industries that you will see. And not just the export opportunities, the whole Make in India theme where you're looking at import substitution. That's again changing the landscape.
So essentially the theme overall is our manufacturing and engineering capabilities.
Correct.
To supply for the world.
Correct.
This is the one mega trend that you're seeing.
Absolutely.
And you're identifying these small companies which are mispriced right now, but have 20 years of vintage, who can capture this market share, which is up for grabs.
Absolutely.
Any other mega trends that you are looking apart from this?
As infra ancillaries and consumption at that.
Okay.
So again, if you look at infra ancillaries, government over the last 15 years have been doing the heavy spending on infra. I mean, we live in Bombay. If you look around Bombay, the coastal road, the metro work and everything else, this is all infra.
Yeah.
You look at the quality of roads which has happened on a pan-India basis. It's been an absolute game changer. And that's leading into multiple other opportunities. So on one side, you have the infra providers who are building up stations, airports, roads, and multiple other things. On the other side, this is fueling the entire consumption in tourism. So that's again becoming a game changer or a multi-decadal opportunity to look at.
And the last one, you mentioned something else, infra ancillaries and then
The consumption theme.
consumption theme. What is that?
Well, India is an aspirational market with our GDP growing at 6.5%, 7% or 7.5%. This eventually has to result into consumption. Aspirationally, Indian demographic and with an average age of about 28, everybody wants to have better products to consume. And this again is changing the whole landscape in terms of the different products which are available in the market, quality and multiple other things.
So, okay. So let's take a couple of steps back. So let's look at Equitree PMS ka track record. 13 years of you doing this.
Sure.
This is from when?
2012.
2012. From then. What has been the best 5-year returns that you've gotten, point to point, during your tenure of your managing this fund?
Best 5 years, I believe it's about 52% compounded returns.
52% CAGR was the best that you gotten in a 5-year period.
That's right.
How did you do it? What happened during that period?
Well, it's just that one, being early into this businesses help, because if you are buying businesses which are not on the radar of institutional investors, not as much spoken about, then when these businesses scale up and get onto the institutional radar, and the business is compounding. So there are two components to this kind of return which gets generated. One is the underlying growth of the business itself. So most of our businesses end up delivering a 20 to 25% compounded growth. Now, what that leads into, assuming that no re-rating of the stock happens, and if I end up holding the business for good 5 years, at a 25% compounding, that itself results into close to about 6x. So you don't have to do anything. You just need
25% over how many
over a
years?
5-year period.
It results in 6x.
Yeah.
Okay. Interesting. So let's talk about small cap category as a whole. Now, if I look at the macro story of what we are hearing, is that small cap sector as a whole is overheated and overvalued, right? If you, depending on who you speak to, they will say that, avoid small caps for now. The valuations are really expensive, and there's a lot of volatility in that sector.
Yeah.
So as somebody who has dedicated half of your life investing in this particular theme, how do you actually look at small cap investing? Is this something that is evergreen, that I can always look at investing in this field? Or is it like there are certain periods of time where small cap investing works? How do you look at it?
So to begin with, Sharan, we don't look at investing from that market segmentation perspective, that is, this is small cap. I think we look at investing more like a business approach, a business investor's approach, irrespective of the market cap to begin with. Yes, we find our opportunities largely in the small cap segment, but the difference is the perception about small cap or the listed market is to make quick returns out of it.
Correct.
Now,
Because I'm taking more risk, I need...
There the greed sets in. What you are trying to do is predict how the price is going to be tomorrow morning, or in 1 week's time, or in 1 month's time. And that's where the errors creep in.
Because there is volatility there.
Because there is volatility there. You don't know enough and more about the business, and which is how you end up losing money. In fact, statistically, 7 out of 10 small cap companies have been value destroyers.
7 out of 10 small cap companies have been value destroyers.
Yes.
What is the definition of value destroyer?
If you are buying 10 companies, probability for you to lose money is extremely high in 7 of those.
Okay.
And when I'm saying lose money, it could be completely zero.
Oh, that's what value destruction
That's what value destruction could be. As much as getting to zero.
You're saying 7 out of 10 small cap companies can go to zero?
Well, zero could be a little exaggeration, but it could be down like good 60-70% and never recover.
Wow, really?
Yeah. And that's why most retail investors end up burning their fingers or hands into this genre of investing. Primarily because you are chasing stock price rather than understanding the underlying business. In my career, as Equitree, all put together in the last 13 years, we have invested in only 42 companies.
In the last 12 years?
In the last 13 years,
only
all
42
put together,
companies.
only 42 companies.
Wow.
And at that, our success rate has been about 85%, which means
How do you define success of a stock pick?
that's what. I mean, I just explained to you about value destruction, right? 7 on 10 have been value destroyers. In our case, 8 out of 10 have been huge value creators, which means that 8 out of 10 businesses would have given us a compounded return of at least 30%.
Wow.
And the difference between being that majority value destruction versus in our case of being majority wealth creators is largely because of the underlying businesses and understanding the fundamentals.
So, how much percent of a retail investor's money should be in small cap stocks, according to you?
That depends on their own risk profile. I mean, every investor can have the different risk profile.
Let's take the risk profile of very risky investor, somebody who is not investing it for the short term, who's investing it for the long term, and can also stomach the volatility of 20 to 30% in the
Well,
worst
in
case.
that situation, I mean, okay, let me put it this way around. Somebody like you, right? Probably were in the early 30s or something, right? Where you have a risk-taking ability and you're not going to lose your sleep over the volatility, you could be maybe even 30-40% allocation into small caps, because that's where the real wealth creation happens.
What about you personally? In your net worth, how much is in small cap?
You leave aside my home, which I live in, and I probably would be 100% invested into small caps.
Wow. All your money is in this fund.
Yes.
So give me an example where you showed some crazy amount of patience, where you're almost at the brink of losing your hope, but then things turn around and it came back to...
We go through this thing all the time.
Okay.
Right. So again, one of our portfolio companies, it's a company called HBL Engineering.
HBL Engineering.
Yeah.
Okay.
When we invested almost about 7 years back, we started buying at about 20 rupees.
20 rupees per price share.
Yeah, per share. And for 4 years, the stock did nothing.
Same, 20 only.
When it went between 20 to 60, came back to 20.
Oh, that also happens. 20 to 60, 60 to 20.
Yeah, we've gone through all of those volatilities.
And you kept holding it.
We kept holding it because, again, like I said, we understood how the business was reshaping. The whole revenue mix was changing. So this was a very old company doing industrial batteries. And they were moving into electronics for railway application and defense applications. And we knew that as and when they get ready with the product, it's a multi-million dollar opportunity.
So they were focusing on their R&D.
They were focusing on the R&D, the product development was going on. In those 4 years, interestingly, they became debt-free.
Okay.
So we could see year by year that the balance sheet was getting stronger and stronger and stronger.
But still 4 years is a lot of time.
It is a lot of time. But this is like having a Chinese bamboo, right? Probably you will see nothing for the first 4 or 5 years. And suddenly in the 6th year, you will have a 30 feet tall tree. And that's exactly what we experienced in HPL. In 1 year, the stock price moved from 60 to almost 350.
Wow. No, you started from 20.
We started from 20.
Then it became
350 in the 5th year. But 4 years, it showed nothing.
the last year that sudden thing happened.
Well, today the price is about 800.
Are you still holding it?
We're still holding it.
And you got in at 20.
We got in at 20.
800.
Yes.
So
It's 40 times
40 times. Wow.
over a 7-year period.
No, but my question is, see, 4 years you waited and the entire hope is on the R&D working out.
Yeah.
How do you assess whether their R&D will work out or not?
Now, so here's the thing. I mean, the way we looked at our investing is that there was a base business which was a bread and butter business. And that base business should have delivered X amount of growth. In our case, it's always about 20% growth. We knew that these products...
When you mean growth, you mean like revenue growth should be 20% year on year.
Correct. The profit growth should be 20%.
Earnings growth should be 20%.
Earnings growth should be 20%.
How do you predict that when you enter a stock?
You cannot predict it to a 200% surety.
Right.
But like we discussed, you look at the addressable market opportunity, you assess the execution capability. Basis that, you can have a good 70-80% visibility for a 12-month period.
Okay.
And a hope that, this is how the business will turn out over the next 3-4 years.
Sure.
Now, why we believed this thing is because Indian Railway was going through a transformation. I mean, earlier, Rajdhani was the only train which was probably running at 80 kilometers, and Shatabdi at that, right? Vande Bharats were getting introduced, and Vande Bharat was supposed to run at 120 kilometers per hour. And that was changing the, again, scheme of things the way it is. Government's intent was to increase the throughput on the railways. I mean, freight trains used to work at a speed of about 30 kilometers.
Okay.
So you can imagine that from a logistics perspective, the amount of time that it would take for a round chakkar to do. The intent was to increase the throughput. And how do you do that? Either you lay double the tracks, which is far too capital intensive business to do, or you deploy signaling systems and auto braking systems to reduce accidents.
So that they can go faster.
So that they can go faster. So HBL pioneered this whole concept.
Wow.
Where they worked on this anti-collision device. And what that does is, if you have the two devices fitted into two locos, which are on the same track, the device will auto-sense that somebody is incoming and will auto-brake even at that speed of 120 kilometers.
Wow.
Now that's game changer.
So this technology they developed in-house, but I'm assuming this technology is also available in other countries.
Well, it is available, but it is almost about 3x of what the domestic guys have now.
So they're like reverse engineered what other countries have done.
In a way, probably yes.
So can we now talk about the sectoral allocation in your fund? How do you look at sectoral allocation? Is that a focus that I will only have X% in each of these sectors? So can you just break that down for me?
So generally we don't buy more than 25% in one single sector.
Okay. But do you have some sectors that you specifically focus on, or are you sector agnostic?
It's the other way around. We understand what we are not comfortable doing.
Okay.
And it's important to have the negative list upfront.
Oh, that's interesting. What should you not be doing?
Whatever you don't understand. It's very simple. It's as simple as that. So whatever you don't understand, don't do. We generally don't invest into real estate developers.
Acha, why is that?
It's not a bad business to be in, but just for the sheer fact that we cannot reasonably fathom how much construction will be done at what point in time, how the cash flows will come, how the cash flows will be utilized. I mean, all of us know that despite RERA and everything else, developers have their own ways of doing things.
Right.
There are multiple other transparency issues and whatnot with respect to the whole sector. So it's a conscious decision. Not that everybody is bad, but it's a conscious decision that that's something that we are not comfortable doing.
So let's take another internet company which has become really big, Amazon. Right? Amazon for decades did not make profits, and even their core business did not actually end up making profits. It was another business entity that they launched, AWS, which eventually got their profits in the bottom line. But having said that, they are still a monopoly and a category creator of what they're doing, which opens up superpowers, I would say, as a company to disrupt anything that they want. How do you value? Maybe that is what the tech investing is all about, right? Like trying to create monopolies for things which do not exist, which billions of people get addicted to. Like, isn't that a way of looking at it?
Probably yes, but no, that's again where I'm saying that this could be our limitation.
Where you are like, this is too risky for me to even understand.
If I cannot understand, if I cannot fathom the outcomes of this kind of a thing, I'm better off not investing into it.
Fair enough.
Because when the volatility hits, I'll not know what to do.
Because you didn't want.
And that's extremely important. And why do I need to have a FOMO of not having invested into something like this?
Yeah.
If what I understand can also result into a 50x return.
Right. Which you have generated as well. Right.
I'm good in my skin. Let's look at very simply, right? As family, as friends, all of us have, maybe one or two guys who could be very close to you. I mean, you could be very good with everybody, but there will be that one guy or two who you understand where you can, freely discuss everything under the sun,
Yeah.
and who's much more closer than somebody else.
Yeah.
You don't end up making this kind of acquaintances or this kind of friends just because somebody else knows somebody else better. Those can be your acquaintances, for sure. It's the same thing with investing. I am better off always in investing into something which I can understand reasonably better, so that when the volatility hits,
You know what to do.
I know what to do.
So, okay. So, first thing you said is IT companies, you don't like them right now. You mentioned about these new age internet companies, you don't understand them. What is the first thing you mentioned which you avoid?
The real estate developers.
The real estate developers. Any other sectors which are like, not for me?
We generally don't do media businesses.
Okay. These are anyway razor thin margin businesses, right?
The razor thin margins, again, especially when they are content driven. You don't know which of their content is going to...
Their
be
ability
super.
to constantly churn out content which grabs attention.
Exactly.
You are not able to predict that.
Because that is going to drive their monetization and their revenues. So if I cannot predict...
So you would not invest in a content creator's business.
Generally, yes.
Yeah. Because you can't predict whether they'll have the attention or not.
I don't have the expertise. I'll put it that way. Not that, again, don't get me wrong, it's not a bad business to be in.
Yeah.
It's about my ability to understand that thing better.
So what are your favorite sectors? One is manufacturing.
It's largely that. So manufacturing, engineering, these are very broad-based things, right? It could include pharma, it could have auto ancillaries, it could be apparel, it could be
So it
capital
is
goods company.
it's function, the function is manufacturing and the sector could be anything.
It could be
with respect-
multiple, yeah. Infra ancillaries is what I spoke to you about, right? So the railway thing probably fits into the infra.
Right.
We have a very interesting business in the infra segment, which is a play on the roads. So we invested in a bitumen company, for example.
Okay. Bitumen company.
Yeah, I mean,
They make bitumen.
simply put, damper.
Damar.
Right.
Company which makes damar.
I mean, they don't make it. It's an imported product, but it's a very difficult product to handle. And these guys have almost about 40% market share
In what? In India?
in India.
40% market share.
40% market share.
And he's just importing it.
Well, you import and there is a last mile processing that you end up doing. But the crux is in the handling the logistics part of it. It's not about just bringing the bitumen in, but it's the logistics part of it because bitumen has to be imported in temperature controlled environment.
How big is this business? Revenues?
Probably this would be about 1,200 crores in terms of revenues.
1,200 crores.
Yeah,
And what kind of profitability does he generate?
This year, I think they should end up close to about 100 crores.
100 crores profits.
Yeah.
Wow. All right. I think let's end it on that note. Thank you so much. I think this has been a very big learning session for me because this is not something that is common wisdom because everybody is afraid of small cap as a sector because that's what the media likes to say. But I got a very fresh outlook as to how do you actually look at the small cap sector and how is wealth made while investing in the stock market, right? The general perception of buying and holding it for a couple of years versus holding it for 6-7 years, these small companies which are really disrupting the way manufacturing is done and not just building things in India, but building things for the world.
Yes.
So thank you so much for coming and sharing your wisdom.
Thank you. Thank you so much.
Any last piece of advice you would like to share?
Like Harshad Mehta's dialogue was there, right? India pe laga do.
Okay.
This is India's decade.
This is India's decade. All right, guys. Thank you so much for watching till the end. If you felt like there were any questions that you felt like was missed out on, please drop them down in the comment section below. And please give me your recommendations for future guest recommendations, and I will try and get them on the show very, very soon. On that note, I'll see you in the next one.
Before you go, guys, if this episode gave you even one insight that made you think differently about money, don't just keep it to yourself. Share it with your friend or family member who could use it too. And if it sparked a new thought or even made you disagree with me, drop a comment below and tell me why. Your critique helps me make these conversations sharper and more useful for you. As long as you have me subscribed, I'll make sure that you walk away with at least one new thing every Wednesday.